These turbulent times, where should we be putting our money? BlackRock says European equities are a good bet for investors prepared to tolerate volatility. The world's biggest asset manager has given us an exclusive sneak preview of their European equity market barometer. Its head of European equities can talk us through it now. Nigel Bolton, thanks very much indeed for joining us. Great to have you on the programme. Just explain this barometer system for us, very, very briefly, in layman's terms.
Yeah, sure. It's something we devised about a year ago now, really to help our clients just visualise what our thoughts are about the market. And so we use some key inputs. The most important for us is earnings and the earnings outlook. We also look very much at the macro environment, and certainly this year has been a macro-driven market. The other factors that we really think are important are investor positioning, where investors are in the market.
Well, Nigel, sorry, we don't have masses of time, so let's take a look at some of those things individually, and let's take a look at your first barometer, if I can put it that way. And I suppose if it goes to 3 o'clock, things are bad, and if it's 9 o'clock, things are not so good. So this is the corporate earnings, and the blue arrow you see on your screen, that is the position now. The white arrow, the smaller arrow, is where they were in the last quarter, where BlackRock was thinking.
Correct.
And as for corporate earnings, you're saying that earnings are, we believe the earnings-driven equity bull market of the last 2 years has ended. What sort of period are we entering then?
We're entering a much more challenged period for earnings. You can see how consensus has really come down from kind of 15% to 8% for this year. But I think the major concern now is where are earnings going to be in 2012. And, I think we're going to be lucky by the time we get there to actually ending up with a positive number. So I think in the short term, earnings still have to have some more downgrades. So we are cautious on the short-term outlook for the earnings in Europe.
And what do you expect companies to do to actually protect their bottom line? Are we going to see much more job cuts like we're getting from Bank of America, or whether it's Peugeot, or that's the latest news that we've had on unemployment today?
Yeah, I think the next few months are going to be very interesting for companies because, we've had this worry in the financial markets over the last 2-3 months, and that's really now starting to come through in the economic statistics we've seen. It's also, I think, starting to worry companies. So I think cost-cutting, a lot of businesses that we've been talking to over the last few weeks are saying, they're preparing plans. They're not pulling the plug yet, but I think they are preparing plans for cost-cutting. So I think you're right. I think that's unfortunately what we're going to hear more of over the next few months. OK, let's take a look at your second barometer, and we take a bit more on valuations. If we can just bring that up on the screen, because it would appear that you haven't actually changed your position much since the last quarter. Still fairly positive. And as far as valuations are concerned, there is a lot of good companies out there with good business models, and equities are very cheap relative to other asset classes and pretty attractive if you've got the stomach to really to go through this volatile time. That's exactly what I would say. I think that's exactly right. I think, in the short term, we're still being very much driven by the macro factors that are coming in here, the political factors. But from a valuation point of view, the market is very cheap. And for long-term investors, we see some very attractive companies. And I'd be really going towards more the quality end of the market, strong balance sheet, strong cash flow, good management. And I think dividend yield will be increasingly important for shareholders going forward.
I was going to ask you about that. How do you see dividends going forward? They are becoming increasingly key because you don't get many returns from other things.
Yeah, I mean, the capital is going to be relatively limited, I think, in the short term at least. So I think the dividends will become increasingly attractive. And, there are many sectors in Europe where the dividend yield now is actually above the corporate bond yield. And I think that's going to be a key attraction for a lot of investors if they start to come back into the equity market.
OK, Nick, let's take a look at your third. We're talking about investor positioning and where people should be putting their cash. And if we can take a look at that particular barometer, and as you say, as it goes towards the left of your screen, that's more negative. And again, you've kept your focus here, but interesting, you've been saying that there's been a lot of substantial net outflows. Investors have flocked to perceived safe assets, and investors are generally underweight in Europe. So exactly explain your reasoning as to exactly where we are and where we're going.
Sure. So our analysis shows us that global investors are very underweight in Europe. So that, for us, is actually a positive factor because we think, they can come back. At the moment, we don't really see that there's much global asset allocators moving out of European equities. I think they've done most of that selling. And I think, if anything, people are starting to look again because of the extreme valuations. Europe in a global context is the cheapest of the developed markets. And I think that will become increasingly attractive to global investors once they have a little bit more confidence in the macro macro-political environment.
Yeah, nothing's really going to happen, is it? Because until we get a resolution, certainly to the European debt crisis, it doesn't seem to be on the cards anytime soon. How have you factored in the real possibility of a default in Greece? Because that could really turn everything upside down.
We think a large part of that actually is already priced into the market. And if we get a crystallization, even though that might seem to be bad news in a default type scenario, if it is in a controlled way, then I think actually investors can then put a line underneath the valuation of the market. And I think you would see funds coming back in because there are some very attractive companies out there in Europe now on exceptionally low valuations. OK,
well, let's take a look a bit more at some of those macro factors. And the uncertainty, I think everybody is agreed, is the watchword right now. Let's take a look at your fourth barometer and see how that's actually compared to the last time. And just remember that if it's on the left, it's more negative. If it's on the right, it is the blue arrow for this current period, the white last time, and you are much more negative here.
Yeah, and that's exactly, really the point we've been talking about. It is that macro-political overlay. We don't know what the timescale is and what the eventual outcome is.
And what's quite worrying as well, you say we haven't seen a situation like this for 60 years.
Yes, well, that's partly to do with the massive global deleveraging we have. That is one factor which is a negative. The complication in Europe, which is extra and above what we see in, I guess, other regions in the world, is this Eurozone crisis and the Greek debt crisis. And that needs to be resolved. We need to have some more certainty for investors. Then you can put a proper valuation on the equities. And then I think, actually, the end result is you come out being quite attractive.
How do we get rid of some of these barriers? Greater fiscal integration in Europe, is that the key as far as you're concerned? Because it doesn't seem to be greatly on the cards at the moment.
Yeah, I mean, the Eurozone faces a crossroads here, and it is on one side greater integration, and on the other side, I think ultimately you do end up with a breakup situation. And that is the worst case, that this drags on for a lot longer than we anticipate, that it just continues in this kind of rolling crisis. I hope that's not going to be where we end up.
Can I just very quickly ask you about your general outlook finally? And do you think we should actually be seeing more stimulus, which is quite difficult when so many countries are trying to get their debts right down? A brief conclusion, if you would, sir.
I think it's going to be very difficult because of the structural deficit, the structural debt problems that we have at the government level. I think more important is restructuring, getting the economies more competitive, allowing businesses to create jobs and allowing the economy to grow through the private sector.